interesting things about how the global market is working. So first, starting any sort of activity or trading activity in the markets, it is very important to understand the workings of this market, how it works. One of the major general patterns in global world price building is trying to understand the dynamics of the major currencies, the major commodities, and major indices. So this is what the world prices are actually about. The major currencies to trade in the global markets today are actually not very many of them. There are not very many of these currencies that we can mention. Usually they are traded in pairs. They're not traded by themselves. They're traded always in currency pairs. For example, the euro and US dollar, JBP, Great British Pound, and US dollar and Swiss francs, US dollar and Japanese yen, New Zealand dollar and US dollar and Canadian dollar, Australian dollar and US dollar. These are the major currency pairs in the world. They have their sort of prices, the exchange rates. The exchange rate of these currencies is what we call a world price that is set on the global markets. This price can be seen in various time frames. For example, here I've got a daily chart. That means each of the candles depicted here on the graph represents one day. I can also change that and take, for example, a 5-minute chart, a time frame of 5 minutes. What does it mean, a 5-minute chart? It means that each of these candles represents 5 minutes. Basically, a candle in this particular graph means a closing price and opening price, as well as minimum and maximum price. Each of these candles has 4 different quotations. So that means, for example, at 19:05 today, the market opened. The 5-minute candle opened at €1.18244 a US dollar. The maximum was $1.18244 for €1 of. There was also the minimum price, which is low, which is called in this example low, and it stands at $1.18222. So that's the way it works. So each of these candles has a minimum and maximum price, and it's a 5-minute chart. Usually that sort of time frame is used to trade during the trading session, and this method of trading is called scalping. It is very risky because each of the 5 minutes this graph is going to change, and it is really going to be very difficult to trade this way, and that sort of aggressive market activity. World price dynamics for this exchange rate could be understood via a more general analysis, and in order to understand how this analysis works, we should really take a more long-term time frame. For example, the one we've started, a daily time frame. What do we see here in this on this daily time frame chart for the euro US dollar? We see that starting somewhere from July the 20th, the euro was quite stable against the US dollar, and it evolved around a price of $1.18 against the currency of the European Monetary Union. There were, of course, some fluctuations going up and down, but in general the euro was very, very close to that sort of measure. It is very interesting to note that euro actually started its general pattern of increasing value against the US dollar after the United States Federal Reserve Bank announced stimulus package back in March. That was actually on March the 22nd, when the US Fed announced a very great fiscal plan for the United States economy. The US Federal Reserve also had other far-reaching plans for the global economy. They extended swap lines with other central banks of the world, including the European central banks. What generally a swap agreement means is that a central bank of the European Union, the European Central Bank, gets a very extended and flexible access to US dollars. It can freely exchange their currency against the US dollar and have the needed liquidity. The liquidity which was very, very necessary for the European market, so that the trading activities did not stop and there were not a collapse on the financial markets. So that was a very important turning point in the euro US dollar exchange rate. If we look at the graphs of other currencies, for example, British pounds, Swiss francs, Japanese yen, we'll see the same sort of picture. So right after the epidemic started, there was a huge slump in the markets of all currencies in the world, until the United States Federal Reserve stepped in and gave that huge fiscal stimulus and monetary easing policy, quantitative easing, which led directly to an increase in currency exchange rates all across the rich and developing world. That was back in spring, in March, and since then all currencies actually stabilized at some sort of a level, and that was due to mainly also unpredictable results about Donald Trump's re-election in the United States and many other things. But generally, what the current situation on the world commodity markets, on the world markets of major currencies say is that the global economy stabilized a bit. It's despite the coronavirus crisis, despite the uncertainty about the elections in the United States, we see that the markets really stabilized, and that is very, very good for the global economy, for the international financial system. Let us see the markets of gold, which is the world gold market. That's one of the major markets. because gold is a sort of a haven investment asset that is stored by investors in many countries as a safe haven asset. If we look at this chart again, you see again that the price of gold stabilized after its long and prolonged rise right after the United States announced a great package, and US dollar sort of started its flood, the influx of money. There was a huge monetary stimulus on part of the US Federal Reserve, and that was the reason why the gold started increasing in value, because investors started selling dollars and buying more gold in order to save their assets. And that's the reason why gold increased dramatically. It reached an historic high on August the 4th, I believe. The gold price reached an all-time high at something like $2,000 US. Before the pandemics, before the start of the new year, in December 2019, the price of gold stood at $1,550 an ounce of gold. An ounce of gold is a measure to understand how much gold and how many dollars you require in order to buy a certain amount of gold. An ounce of gold usually contains 31.1 grams of pure gold, and that's the price. That's the world price. That's taken as a standard measure of the price of gold across the world. In each of the exchange markets, each of the stock exchanges in London, in New York, in Tokyo, the gold is measured in troy ounces. That's how it used to be in the past, and that's how it's going to be in the future. What can we see also on this daily chart is that like any other asset, the gold price is very volatile. We can see that usually if something happens in the world economic events and financial news, this immediately expresses in something very dramatic. Just like today's extraordinary times, in today's extraordinary times, we see an increase in gold prices, but we see also the decrease in oil prices. If we take a very standard measure for for example, WTI, which is a standard measure of oil in the United States, if we take this chart, we can see that the price of oil was also very, very volatile this summer, and in particular it started its general slump after the pandemics hit this market. It was a very, very dramatic occasion in the history of the world oil market. If we look back at history, and last time we tried to say a couple of words about the global oil markets and the global oil prices, how they developed through through decades, we can see that the price of oil was very high right before the global economic crisis, global financial crisis of 2008, when it was something like $150 a barrel of oil. Today we see quite a very different picture. Today we have very many problems with that sort of standard measure. In May, the price of oil was close to $13 a barrel of oil. That was a very dramatic event. Russia suffered very greatly from that, and many other markets in the world, including the OPEC countries, the countries that produce and export oil. They also suffered greatly from that slump. The United States, that became the largest oil-producing nation in the world after Donald Trump was elected president in 2016. After the combined efforts on parts of the OPEC, the US government and Russia, these countries all together came to an agreement, and they started to reduce the production of oil, and this actually led to an increase in the price of oil. The price of oil first stabilized and it started to increase. And now we have this sort of picture. The price of gold doubled, the price of oil, a barrel of oil, doubled from May. Now it's something close to $40 a barrel of oil. And that was good news for Russia. That was good news for Saudi Arabia and other Arab countries. Also, we are very concerned, of course, about our own currency. The Russian ruble is a currency that is very, very dependent on the price dynamics of oil. Russia is also very, very dependent on international sanctions and how they're going to work against our country. And we also can see from the general pattern how the ruble actually developed in the recent history. Russian ruble actually is not a very, was never a very stable currency in memorable history. After the market reforms in Russia in the 1990s, with the period of hyperinflation, we had a very difficult time. Russia really suffered serious losses, and we can see that today, actually, we're not going to go too far in discussing the ruble's dynamics, but if we just take that sort of picture, we will see that all across the year 2019, ruble was sort of stable. Its exchange rate against the US dollar was something like 64, 65. In January 2020, in January 2020, ruble appreciated against the US dollar very dramatically. It stood at 61 rubles a US dollar. That was very good news for the Russian economy. But many people felt that that sort of good news is not going to happen to infinity. Many people started buying more US dollars in January in expectations of great events. In January, in particular in early January, nobody knew what's going to happen next, that there will be that very dramatic situation with epidemics in China, and nobody actually believed that even after the break of epidemics of coronavirus in China, people still were very, very euphoric about the successes on the stock markets, and they were not really concerned about what was happening in this country. But other people felt that there is something fishy here, and ruble cannot be so strong against the US dollar, and there must be something that's going to change. And it really started changing. Things started accumulating, and they were certainly not in favor of a Russian ruble. So since the start of the epidemics, ruble just suffered a huge slump. By mid-March 2020, ruble devalued, and it lost almost 20 rubles against the US dollar. That means something close to 50% devaluation. This is very serious. That was a very serious economic development for the Russian economy. After that, after the United States announced its package, actually the United States Federal Reserve System saved many countries in the world by issuing more dollars. If the United States did not issue more dollars, if they did not approve that huge $2 trillion stimulus package, countries all across the world would have suffered much greater losses. Their currencies would have depreciated more, and we do not know the scope of those the scope of those negative and dramatic events. Actually, we can blame Donald Trump and the US policies for many bad things happening in the world today, but certainly not this one. That was a very, very positive doing on part of the US administration and Donald Trump, and we should thank them, because that was very, very good for many economies in the world. So ruble started appreciating against the US dollar, and it almost everything was quite okay. By early June, ruble stabilized at something like 68 rubles US dollar. The economy was quite doing all right. But then there was again a new wave of international sanctions against Russia, and we've seen that sort of general pattern that again led to huge increases in the price of the dollar. Also, what was one of the major events and factors behind such a devaluation in June, what started in June was that the Russian central bank decided to lower interest rates. But they did not do this only once. They did it on a repetitive basis, and they slashed interest rates, the rate of refinancing, down to almost 4%. This is very, very low for the Russian economy, and the market reacted very, very aggressively. So the people, the investors on the market started buying more dollars, in expectation of more negative events accumulating against the Russian economy and other things. And so by mid-October, actually the ruble again lost in value. It almost reached the level of March. That means ruble devaluation actually sort of repeated the amount of devaluation. It was very, very dramatic for the Russian economy. Ruble was something like 80 rubles a US dollar again, like that was in March. What's going to happen next, of course, largely depends on what's going to happen with the elections in the United States. If Donald Trump is re-elected, maybe we will see the US dollar getting weaker against a variety of currencies, major currencies in the world, including Russian ruble. And by the end of the year, we will probably see more ruble appreciation. Actually, before the elections, many investors thought that the US dollar is going to weaken and Russian ruble is going to gain more strength against the American currency. And maybe it was going to stabilize at something like we saw in early June 2020. So that means 69 or 68 rubles a US dollar. So that sort of analysis requires usually too much analytical skills, too much time to think about those events, to think about many factors that are influencing the prices of oil, gas, and other currencies in the world. So this is how it works. Also, what I would like to tell you about is, of course, some sort of analysis and predicting prices. It is very interesting to understand how the prices are changing and what can we expect actually in the future. Let's take one example, which is the price of gold. Like I said before, today gold is a very important asset. It's one of the major asset classes in world history, in the history of world finance and international money, international monetary policy, international monetary system, and things such as these. So I would like you to look at this graph. This is a daily chart. When we start making our research and analytics about the price of gold or any other asset on the world market, we should actually find a sort of a stimulus point, the starting point when the price dynamics started its general pattern, its general downward or backward or uprising pattern. So like I said before, in March, on March the 19th, the United States US Federal Reserve System, the United States Fed, declared said that it's going to support the world financial markets by more stimulus and by issuing more dollars. The United States Federal Reserve decided to issue more than $2 trillion in order to extend swap lines, in order to provide more liquidity on the markets. And that was a starting point for the gold rally that really lasted until August the 9th. On August the 9th, what changed back then in August the 7th or 8th, the preceding days to that event? Well, actually, when we look at the dynamics such as these, we can say that an increase in prices for assets such as gold or platinum, things such as these, cannot go further to infinity. So there must be some sort of a blocking situation. And that blocking situation was, of course, that there was a very unpredictable situation about further stimulus package on part of the US government. Also, the markets stabilized a bit, and many investors started thinking about buying more stocks and equities of big tech companies in the United States, such as Apple, Google, and Amazon, companies such as these. As they were very, very great in demand, they actually gained value and accumulated much capital during those days. So this is a starting point for a new trend in the price of gold. And that, like I said, happened on August, if I'm not mistaken, that was August the 7th. Here on this graph, we can see this starting point for a new general pattern. And this pattern tells us that the price of gold started its downward slide, and today it dropped from $2,063 an ounce of gold down to $1,880 an ounce of gold. In order to understand how the price of gold is going to develop in the future, by the end of December, for example, what should we do? We should construct the Fibonacci lines. Fibonacci was a great Italian mathematician, and using this sort of technique on this platform, I construct the Fibonacci lines starting from the stimulus point back in August, when everything started its downward slide in the price of gold. So that's the starting point for that sort of development. What I can see here, what are these lines actually? What are the Fibonacci lines? Fibonacci, like I said, an Italian economist who lived in the 14th century in Florence, he said that all events, all things and mechanisms in nature are happening according to some sort of general patterns, some sort of laws of nature. And if something develops up to a certain point, and if that something breaks that point, then that sort of thing is going to choose its level and go up or down, like we see here. For example, the price of gold broke through the line 61.8 again a few days after after gold started its downward slide. So it broke the line 61.2. Later, the next day, on August the 12th, it broke two more lines and actually almost touched the line 23.6. That was on August the 12th. That was a very dramatic example of price fluctuations on the world markets. If we take a crosshair view, a crossbar, and see how many points the market actually lost in these 4 days, we see that this is a 10% decrease in the price of gold just in 2 days. In points, a point, actually a basis point, is a general measure for the movements in world prices. And we see that in these 3 days, the price of gold broke down and lost over 21,000 points. If you were a very good strategist, a very good investor back on August the 7th, and if you sold instead of buying the gold, you would have gained a very huge amount of money, actually, a very great sum of money back then in August, just in these 2 days. For example, if you bought something like one lot of gold on that day, in a couple of days, on August the 12th, you could have gained $21,000 just by closing your positions on August the 12th. So that was a very great opportunity for many investors to gain lots of money. Actually, that was a second great opportunity after the coronavirus crisis began. When things started accumulating and the market broke down back in March, we can see that it also lost 23 or 24,000 points. So again, if you were a good strategist and a very good investor back then, you could again gain lots of money. If you sold one lot of gold back in March, you could have gained again over $20,000 just by selling a lot of gold. But if you sold 2 lots of gold or 3 lots of gold, this is of course much, then we can talk about much greater sums of money. And also, if some of you were very good investors and with long-term view, and if you started a new strategy back in March after the coronavirus started hitting more and more countries, and if you bought gold somewhere here on March the 20th by early August, the price of gold changed. It actually gained over 42%, or 61,000 points. That means if you bought one lot of gold back in March, you would have gained $61,000 by the end of that period, by the early August. This is a very dramatic economic and financial event in history of the gold market, of the world gold market, actually. And that's a very, very interesting and very important event in the gold market and in the life of many investors. What we can also do here, trying to understand how the price of gold is going to work later, we can we can extend the Fibonacci lines using another technique, using daily horizontal lines. If you look again at this toolbar, I put these red lines to extend the Fibonacci lines, and I do that. I do extend these lines for all the other Fibonacci lines, like we see here. The line 23.6, 38.2, 50.61.8, and also probably we can expect the gold price reaching a historic high, like it was in early August, of over $2,000 an ounce of gold. So this is a very, very interesting thing. Also, what can we use in terms of toolbars here? We can construct a channel. All world prices actually develop in a sort of a channel. A channel is being constructed using, again, a sort of a geometrical figure here, trying to find the maximum and minimum points in the gold prices, in the gold price over a certain period of time. If we use it like here, if we put that general pattern, this channel, we can see that the price of gold actually may develop in this sort of way, like here. So up from now, the price of gold may go up somewhere up here, then it's going to correct down here again, perhaps. Later it can also go up, and after that it can go down even further. So what we see here is that the general pattern, if nothing more important happens in the world economy, if there will be everything okay in the United States, in the economy of the United States, in the unemployment figures in the United States, if everything is going to be okay in the Eurozone, in Germany in particular, in Great Britain, if there won't be any other more serious financial and economic events that would really be important in terms of the financial markets developments, then this pattern is going to continue all until the end of the year 2020. And also, if the number of infected people in the world does not increase, why the price of gold is going down? One of the major reasons, again, is the price stability on the world markets in general. Also, and that many countries in the world started gaining more control about this coronavirus situation. Many countries got used to lockdowns. Many people got used to working from home. And there was the end of this period of great financial hysterics on the global markets when people just did not know what to do. And they just sold everything and bought more gold. That's the reason why gold actually hit an all-time high of over $2,000. Another such situation was back in 2008, when people were also very scared about what's going to happen in the US economy after the Lehman Brothers collapse back in September 2008. And the same thing actually happened this time, but instead of the patterns that were growing and accumulating in the US economy back then with those bankruptcies, today we've got this coronavirus crisis. So this is a general sort of a pattern. What can we also use on every platform to trade in the markets in order to understand the general patterns of the markets? We got to use some sort of indicators, which are called oscillators and trend indicators, volumes indicators, and other very specific indicators, including indicators by Bill Williams, for example, or Ishimoku, or something of the sort. So, one of the major indicators on the market is a moving average oscillator and moving average CD, convergence divergence. What do they show? What do they say, those indicators? Moving average indicator tells us how the price of anything, for example gold, changes on average. For example, during the past 50 days or so, 50 days or 50 single candles on the graph. Let's take this moving average oscillator of, for example, 50 days. Actually, that's where it is. I would like to choose a 50 period example. That's going to be red, 50 candles. So that means it's the average price of 50 previous candles, so to speak. This bold red line shows us the price dynamics of the gold asset in this 50 period chart. And I would like also to choose to take a moving average of 20, a period of 20, and I'm going to make it, for example, blue, so we can see this. What we can see here on using these two graphs, well, it shows actually a long-term opportunity to buy or sell. Usually investors try to think about investment opportunities or buying or selling opportunities after these lines cross. These lines crossed somewhere in mid-September, and what do they tell us, these general pattern? This general pattern tells us that after this, actually, we can think about selling more gold in the future, because the moving average, the blue moving average, actually is lower than red moving average 50, and it shows that after some sort of a period of time we're going to see more decrease in patterns in the price of gold. But that this is of course a daily chart. Usually when investors try to trade on the global gold market, they are taking shorter time periods, for example 5 minutes charts, which are more useful, and they're very volatile, and there are much more opportunities to gain, actually. And also, like I said, we got to also depict on this graph an MACD instrument oscillator, MACD, moving average convergence divergence, and this is usually a graph that's put down here below the graph, and it shows the volume of trades, usually how much trading activity there was in the markets. And what can we see here is that in order to understand the growing or decreasing pattern of the price of gold in the future, we got to understand whether these dynamics diverge or converge. In order to understand that, I just draw lines trying to make a link between the maximums in the market. And what I see here is that according to this analysis, actually, what can we expect is that what we can expect is that we really see a situation that after these two lines cross again, these blue and red line cross again, somewhere here maybe in a couple of days, there will be more opportunities to buy into gold in expectations in an expectation of a gold increase, of a gold price increase. Why do I think so? Is because MACD chart and moving average plus the maximum daily prices are actually showing that the price of that we should actually buy into gold rather than sell it. And that sort of technical analysis shows that maybe in the United States there's going to be more uncertainty about Donald Trump's elections, and right after the announcement people will buy more gold, because due to these uncertainty about who's going to be the next president of the United States and other things, and also things happening in the world gold market, oil market, and also the uncertainty about the coronavirus infections, more infections. I think that now is the time to buy more gold, actually. If I take a shorter time frame, let's move to 5 minutes chart, and I will use the same sort of oscillators, the same sort of techniques to understand what should we do, whether we should buy or sell. But a 5 minutes chart, of course, shows that we actually do that a very short term. If we are very short-term investors, short-term buyers or sellers in the market, that we are very nervous, and according to this strategy, this strategy is called scalping strategy, we can actually find more opportunities of the global sales or global buying activities on the gold market. So looking at this graph, this chart, what we see here is again that sort of pattern. The technical analysis says that we see these lines converging. Actually, they converge. These two lines converge because that is shown right here in this dynamics. I just try to connect these indicators, and what they say is that these lines are converging, and that means today, actually, in the couple of past days, there were opportunities for buying more gold, and this also indicates that maybe we really should buy more gold, and the price of gold is going to increase again due to the activities on the markets. Also, what I'm going to show you just in a couple of minutes, usually when we're talking about the investment opportunities on the global markets, we got to think about global patterns and global economic events. I'm going to again introduce to you the financial sort of analysis, events analysis, which is very, very important. Investing.com is a great website because it combines lots of very useful things. Especially this concerns the news part and economic calendar. Economic calendar is a very important instrument for world prices, because each event happening in the global trade, in the global finance, is going to affect the price of gold, the price of oil, indexes, currencies, and many other things. Last time I tried to explain to you how unemployment figures announcements in the United States affect gold prices. What did I do last time? I'm going to repeat it again today because I think that this is important. This is going to be a very important revision. I'm going to understand how the economic events really developed in the past 10 days. What were the major events starting from November the 1st? I'm going just to use that sort of calendar instrument. Yeah, I'm going to choose November the 1st and November 12th. That's going to be the time frame I'm going to analyze. I apply that to these economic calendar. Also, I would like to choose a more convenient time, because we do not live according to GMT, we live according to Moscow times. That means GMT plus 3 time. That's going to be also very important because, again, we got things happening according to a certain economic part in terms of certain economic and financial events and activities. So, what about the filters? You see here a number of events that are actually not very important. 1 star, 2 stars, that means mid volatility, moderate volatility, or low volatility is expected. That means actually these economic news are not very important. What do I usually do when I try to find the most important events is that I'm going to filter them, and I'm going to select all categories. I want to see employment figures, economic activity figures, inflation index, central banks activities, and things such as these. And highest importance, that means 3-star importance. Then I apply that sort of filter, and it's going to develop an economic calendar for the first half of November 2020. What we see here is a very important calendar of the most important economic events. And like I said last time, each first Friday of the month in the United States, there is an announcement of employment figures. So that means each Friday, on the first week of each month on Friday, there is an announcement. This time in November, that was on November the 6th, Friday, November the 6th, 2020. What we see here is that these figures and employment figures in the United States were better than expected. The United States economy gained more than 630,000 jobs. This is a very good thing. And usually when employment shows much better, more jobs are being created, more than expected, that's going to have a depressing effect on the price of gold. That means right after the announcement, just look at the hour. That's 16:30. This is the time when the United States, when the Statistics Department in the United States announce their figures for employment. Let's see what happened on November the 6th, 2020 at 16:30 p.m. to the price of gold. Let's see. Let's go back to, like I said, November the 6th. November 6th. Yeah. You see this? Or you not see this, maybe. I again try to demonstrate for you this graph of the world price. So this is November the 6th, and this is the time when these figures were announced. This is again a 5-minute chart. Before the announcement, the price of gold was 1960 an ounce of gold. And right after the announcement at 1530, actually 1530, that's because this sort of provider says release these figures, but the time, the Moscow time, is of course 1630 p.m. Let's see what happened. How many points actually the price of gold moved on that day in just in a matter of an hour, at least. The price of gold changed 1% on the downward pattern. It lost almost 1%, or 1850 points. That means if you expected the employment figures in the United States, good employment figures, and if you sold instead of buying gold, and if you sold one lot of gold back then on November the 6th, right before the announcement, you would have gained almost $2,000 just in just during an hour's trading activities. This is a very great profit. Also, when again, experienced traders, when they're thinking about the strategic operations on the market, when the price of gold touches a sort of a minimum on that day, they stop selling and they just start buying into more gold. And if again we were very good strategists and very good traders, by the end of November the 9th, so on Monday, the price of gold completely recovered from that loss. It again gained 1%, or 1900 points, and actually this is the point where many investors could also gain. They just waited because you see here, this is very interesting and very important thing. Trading stopped on November the 6th at 21:40. That's because actually the market goes on holiday, and the market does not work on holidays. And the market opened on Monday at 0 o'clock night, or that was the start of the new day, and the price of gold opened much higher, and actually it recovered, like I said, what it lost on the previous day after the announcement of employment figures in the United States. If you ask why the employment figures are so important for the price of gold, why that sort of statistics announcements actually mean so much for gold and for investors, why do they are so expectant about these figures being released on the market, is because actually employment shows the health of the economy. If your economy, if the economy of the United States is healthy, it's going to create more jobs. If it is able to create more jobs, that means it has more opportunities to grow. That means people are going to work harder, people are going to employ more hours in term to work, they're going to be more innovative, they're going to be more thoughtful about their jobs. Usually when people just found their jobs, they are more optimistic about their future careers and things such as these, especially if we're talking about people who lost their jobs due to the coronavirus and then found their new jobs. I think that usually they work harder and better than people who did not lose their jobs during the pandemic. So that means the economic growth pattern is going to be much higher, and the economy is going to show more healthiness. So that means that actually once the employment figures are released in the United States, we see here very important, very great events in terms of gold prices, because what they said on November the 6th, those employment figures, is that the United States is a very robust economy, and actually we do not need more gold to buy. And the price of gold went down due to that. Yes, it did recover after that. It regained its strength, but later, like we see here, by mid-November the 9th, the price of gold started its downward slide again. It went down again, and actually it fluctuates now in this sort of pattern. But like I said before in the start, right at the start of this lecture, is that the price of gold actually, you see here again I've chosen 1 hour chart, and you see here that after the release of those figures, starting somewhere from November the 9th, the price of gold lost almost 6%, 5.6%, in just in a matter of 3 days. It lost 11,000 points. And I think this happened directly due to the reason that the United States economy showed robustness and very good employment figures. And also, perhaps the markets are sure about or are not do not care about who is going to be the next president of the United States, because whether Donald Trump or either one of them is in the White House by January, the United States economy is still going to stay here at this point, and it's going to show more robustness in the future. That means actually the government programs and plans that were taken right in the middle of this period were very, very effective. Dear students, if you're still here, we've got some time in order maybe to listen to your questions. Do you have something